Hi everyone, it's Jack back with another video. Today I'm going to be talking about Nvidia, going over its Q2 report that just recently released, deciding whether I think it's a buy, sell or a hold based off this and what it means for Nvidia's future. Of course, Nvidia has been an incredible performer over the long term and the company will surely hit $1 trillion in the next 10 years at its current growth trajectory. In a world with increasing amounts of AI, Nvidia will surely be at the centre of this. However, this year it's down nearly 43% year to date. It's looking at being down a further 4% in the after hours market. That's basically because its valuation is quite inflated at a very, very high market cap, which it perhaps didn't deserve. So it's well off its 52-week high, $346, now $172, although it's decently off the low. So I'm going to get into the earnings. So despite Nvidia lowering guidance only a few weeks ago, they still came in very, very poor results, up 3% revenue year over year, which is a significant deceleration. Quarter over quarter, this revenue is down 19%, which is quite worrying. Gross margin down 22 points from 65% in the last quarter to 43.5% this quarter. Again, that is a very, very large decline. And year over year, that's even still down 21 points. Operating expenses were down 32%, which is reasonable, but up 36% year over year. Operating income down 73% quarter over quarter, down 80% year over year. Net income down 59% quarter over quarter, 72% down year over year. These are all absolutely gross numbers, to be honest. Of course, this is in the face of quite heavy macro headwinds, the chip shortage and just general supply chain problems, but this is a very poor quarter, and when you compare it to the likes of AMD, for example, who had a very successful quarter, in my opinion, an excellent quarter, this is extremely worrying. Intel and other companies like them, Micron, also had quite bad quarters, in my opinion, but Nvidia has typically shone above the rest and has delivered 30 to 40% revenue growth, if not more, over the longer term. And this is the first quarter in a while that I've seen them really stink the place up, and that is what this quarter has done, in my opinion, stinging the place up. Even with the lowered guidance, this is still a very poor set of results. To dig into these results a bit deeper, I've got Nvidia's quarterly revenue trend for over the last 2 years. So this is the revenue by different segments: gaming, data center, professional visualization, auto, and OEM and other. Now, OEM and other, auto and professional visualization are not really needle movers in terms of the amount of revenue they're contributing. Combined, they're worth 3 times less than data center, so it's not really worth talking about them. However, professional visualization was down a little bit, but this was more than made up for by auto and OEM. Again, don't really move the needle in terms of revenue. The big two are gaming and data center. Data center grew minutely quarter over quarter, significant growth year over year from 2.366 billion to 3.8 billion. Again, this is very impressive and continues to grow over the longer term, and this will continue to grow over the longer term, in my opinion. Data center is a fantastic segment for this company. The one that tends to be more variable and has been growing at a much slower rate over the longer term is the gaming segment, and this is the real culprit for the loss. The company was down about $1.5 billion in revenue quarter over quarter, and this can essentially be explained by the gaming segment. That was down about $1.6 billion in revenue quarter over quarter, from $3.62 billion in Q1 to $2 billion in Q2. Now, this is extremely disappointing. Obviously, the gaming segment accounts for many major consoles. It accounts for the PC segment, but also accounts for people who are buying for cryptocurrency mining, etc. And this is clearly, we're potentially entering a crypto winter, and there's just not as much demand for this, as well as generally not as much demand for the gaming segment. And this is for sure concerning for Nvidia, but for me, it's relatively short term. What is more concerning is perhaps that the data center segment is not growing anywhere near as much as we would expect. Significant deceleration, quarter over quarter growth rise. You can see the jumps. So if you exclude Q3 to Q4 or Q3 to Q1, 21 to 22, it grew 600 million Q2 to Q3 22, 300 million Q3 to Q4, another 500 million from Q4 to Q1, and then 56 million in the most recent quarter. This growth is not really good enough, and while this is a segment that really needs to carry the business going forward, it is the primary growth driver for this business, and it's just not really working right now. Gaming segment is far more variable segment, and is, while it was the old business of Nvidia, this was the main source of revenue. That is changing, and data center is overtaking it. But I'm even more concerned by the fact that data center has just not really continued its quarter-over-quarter growth as I would like, even though it hasn't gone down. Another concern for me, probably why this stock is down after hours, is that revenue outlook for the next quarter, not particularly impressive at all. $5.9 billion expected. That is versus last year's numbers, $7.1 billion for the quarter. Gaming and professional visualization revenues are predicted to decline sequentially as OEM and channel partners reduce inventory, blah, blah, blah. The fact of the matter is, whether it's preferring for the new product generation or not, this is a serious decline. They believe that the decline is going to be partially offset by a little bit of growth in data center and automotive, but this is nowhere near good enough. Gross margins are expected to be 62 to 65%, so this is a nice recovery over the most recent quarter where it was significantly declines around 40%, and a couple of other things are expecting operating expenses to be approximately $2.59 billion, and on a GAAP basis, which is a little high for my liking, but not ridiculous by any means. CEO Jensen Huang gave investors a bit of hope by saying they're of course navigating the supply chain transitions in a challenging macro environment, but he believes they will get through it. Of course he believes that, and I completely agree. This is the current 40% decline is perhaps a bit of an overreaction, but is, in my opinion, mostly due to its valuation. You just can't grow 3% quarter over quarter if your valuation is 50 times earnings. Accelerated computing and AI, the pioneering work of the company and where this company is really transforming from what was a graphics card company to now a machine learning company. Automotive is becoming a tech industry and is on track to be the next multi-billion-dollar business. Though it's not growing really where you'd like, it's definitely going to become that over the longer term, particularly when cars move to full self-driving. Advancing in AI and driving the data center business, and will continue to do this. I believe this will be a long-term extreme growth driver for this business. During the second quarter, which was nice, is Nvidia returned to shareholders $3.4 billion just in share repurchases. This is following $2.1 billion in the first quarter. The company still has around $12 billion remaining under its share repurchase program, so it's reasonable that while the share price is depressed, I think is not trading at a cheap valuation by any means, but it's relatively depressed. They're continuing to buy shares this fiscal year at a decent price, which I like. Now, despite the most recent quarter, Nvidia's revenue traditionally has been plus 30% a year at least, and as a gross margin of 65%, a net margin of 32%. Very free cash flow generative business, long history of profitability. Of course, it's going to trade an extreme premium. That premium right now is a price to earnings ratio of 46, far above the S&P 500 average. Of course, the growth and free cash flow generation is far above the S&P 500 average, but this is still a significant premium. It shows a lot of growth baked in. However, right now, the price to earnings growth ratio is around 1.44, which is kind of getting towards cheap. It's not bargain by any means. I would consider 1 and under to be cheap. This is kind of a fairly value peg ratio in my opinion. 1 to 2 is kind of an okay price to pay in my opinion. However, a lot of these metrics are just a little high for the prospects of Nvidia right now. 55 price to free cash flow ratio. That is very high. I prefer to see under 20. Even for a company that's grown its revenue reasonably well, this is still very high. Next up, a Dcf calculation. Assuming a 10% discount rate and a 4% terminal growth stage, this company, for it to be fairly valued right now, would require to grow its free cash flow over the next 10 years, a compound annual growth rate of 27%. Now, this is a very high number and one that I don't think is wholly achievable for this company, particularly in the state that it is in right now and the current macro environment. I think this is a large degree of projection. It's certainly not a conservative estimate. I think conservative is 20 and below, in which case this company is overvalued based on this metric. However, over the last 10 years, it's grown its free cash flow at 30% on an average basis. Over the last 5 years, 34%, and the most recent year, before this quarter, 42%. Now, of course, these are often coming from a much lower base. However, I don't think it is ridiculous for Nvidia to grow between 20 and 30%. I just think a conservative estimate would be 20% and below, perhaps. And this is clearly an overvalued company using these conservative estimates. I think it is completely achievable for this company to grow its free cash flow between 20 and 25%, and its revenue, at a conservative basis, I think growing 20% a year for the next 10 years or so. However, with the current macro environment, I think this company has a bit further to fall. Its next quarter is going to be highly disappointing in my opinion. They'd be lucky to hit those numbers if gaming continues to fail as it has done. So we'll see. Personally, I love this company, but I'm not investing right now just because I simply believe that this company has a bit further to fall and I can pick it up for much more attractive valuations. Although, of course, I do think this company is going to be a much larger company in the next 10, 20 or 30 years. It's a fantastic business, very free cash flow generative with a long growth runway ahead of it. So I don't think now is an absolutely ridiculous time to buy. It's just I think I can get it cheaper in the near future. With that being said, I'd like to hear your opinion in the comments down below. None of this is financial advice by any means. I'm not a financial advisor. You should do your own research and due diligence, not just buy because of my opinion. Like and subscribe if you enjoyed the video. I'll see you again next time.